Good morning.
Good morning. How are you today?
Doing great. We had a little bit technical difficulty this morning, but all is well.
Absolutely. That lets them know that we're live. We're not AI.
That is right.
So humans over here still able to have human air.
Right. It's, one of those days, right?
Yeah.
Yeah, how is Vegas?
Well, I braved an early morning walk, which probably added a little pressure on everything, but it was already 90 degrees.
Oh my God, that is it's getting hot. We're very fortunate here in Southern California because it's still in the 70s.
Ah,
So that's
okay.
kind of nice, right? Yeah.
All
All right.
right. Well,
Let's
welcome everyone to another episode of Wealth Doctors. I'm Dr. Stephanie Ardrey, and with me is Dr. Andrea Lee.
hello.
Oh, and we have a great topic. Ooh, want to tell them about the topic for today?
Today, we are going to talk about mortgage protection. Uh, Everybody
Great.
needs mortgage protections, right? I mean,
Yes.
especially homeowners. If you're buying a home, it's a major, financial commitment. We're talking about could be 30 years mortgage. In some cases, 15 years or 10 years, but usually it's a 30 years mortgage. It's a long-term commitment. And how do you protect yourself if if something happened to you, if you no longer here, or becoming ill or disabled? How do you protect your mortgage and ensure that your family would have a home to live in, right?
It's true. And oftentimes, the lenders, they make you carry PMI. So their private mortgage insurance is definitely in place, especially depending upon the amount of the down payment. And they're doing that to protect the mortgage itself from their interest, but that doesn't protect you as the borrower. And that's why you want to look into having your own mortgage protection insurance, because oftentimes, if something happens, you would like to make sure that the property that you've mortgaged for a purchase still is part of the assets that your family, your heirs, are able to benefit from. You may still have family members that need to reside in a residence, for example, or if you have income producing assets, you would like those income producing assets to continue to produce that income, to provide that income to your family and your heirs. And so it's oftentimes something that's not considered, but it's very important to have, and you can control it through your insurance, through riders, and oftentimes there's a lower threshold for
Yeah.
qualification.
Mhm. Yeah. So what is mortgage protection insurance? Short is MPI. So, MPI is a type of insurance policy that helps your family to make mortgage payments for you if in event something happened, if you die before your mortgage is paid off. Certain MPI policies offer, coverage limited times if you lose your job or become disabled after an accident. So this can help to protect you, um, if something happened. Now, what is the difference between MPI and PMI? So, as you mentioned earlier, PMI is a private mortgage insurance. It's completely different, two different insurance here that we're talking about. The PMI does not protect the homeowners. You, as a homeowner, it does not protect you. It protects the lender. And why would you pay a PMI? So PMI happens when if you buy a home with the conventional loans, less than 20% usually, the mortgage lenders will usually, will make you buy PMI to protect them in case you default on that mortgage or something, would happen. So then, that is to protect the lender only. In that mortgage insurance, the PMI could go away usually when you reach to the 20% threshold of the down payment, right? Is that usually?
Yes,
Yeah,
usually it's about once you have about 20%. Yes.
right. So so there is a difference here that a lot of people mistaken if they have PMI, they think they get protected from in event if they lose their job or disable or not able to, or pass away. PMI does not protect you. This is the clarification that we want to make sure that you understand. Because in the past, I had the same misunderstanding. Years ago when I got my first home, I put a little less than 10% down. They made me pay the PMI. And I said, why would I have to pay for this one? It's extra out of pocket. And they said, oh, because you down less than 20%. This is required. You want to get a loan, this is the requirement you would have to pay. And that's part of the lender requirement. But MPI is the mortgage protection insurance. This is something that you can get on your own. It's not required, and you can get that to protect yourself in events of you passing away or lose a job or become disabled that you no longer can work, and ensure that your family would have a home to live in once not there anymore. So it's important to make that distinction between the two, right? So the differences.
Absolutely.
Yeah. So some people have HFA loans, and the HFA loans also have their it's called the mortgage insurance premium too, MIP. So the HFA MIP payments also protects the lender, does not protect you. So people that have HFA, you can see if that's the case, because usually HFA loans you pay what, less than 5% down payment or 5%
Yeah,
down payment?
yeah. Yes, FHA in particular are aimed to be attractive to first-time borrowers, so they make sure that the minimum down payment is lower, it's reduced, and it can sometimes go as low as 3% of the purchase
Oh,
price, and so 3 to 5%. And so because of that, yes, then you're
right.
required to carry some type of protection for the mortgage holder.
Yes. So that
Yes.
is an additional cost that you would have to pay, part of the loan requirement. Now, on top of that, you can get a mortgage protection insurance for your own protection in event something happen. So these are two different, protection that you can get to protect your home in the long run. So it's regardless if you have the PMI or the HFA insurance, it's a good idea to invest into a MPI mortgage protection policy, um, in the event that you cannot afford a life insurance policy, a traditional life insurance policy. And we're going to talk about, what's the difference between the mortgage protection insurance and the traditional life insurance policy. So you have an understanding, if something happened, you ensure that your home goes to your heirs. So there is, the opportunity here is to make to budget into your planning and your monthly mortgage. Right.
Right. Yes, I was able to experience, sadly, but
Mhm.
gratefully, with my mother's passing, is that she had put in place a policy to make sure that if something were to happen, that the home would be paid off. And it was, an easy transfer to have the property transfer over to me without any issues, and those are things that a lot of times, again, you don't think about as much, but they're important when, something happens. And, certainly in her case, she was young, so she didn't expect at that time. She wasn't sick or anything. So it wasn't
But
like she
she was smart. Yes. Mhm.
anything to happen. And so, that's the thing that we have to remember, is that just because we think that we're in our youth, and we feel great and we don't have any particular, elements of concern, doesn't mean that things can't happen. Accidents do happen suddenly. That's why they're unexpected, unanticipated. And so you just want to prepare so that your family, your heirs, your beneficiaries are also taken care of in the event of something tragic happening.
Right. And, a lot of people would ask, how much does MPI cost, mortgage protection insurance cost? So the cost of this insurance is really depend on a few factors that insurance company will examine. They'll take a look at your balance of your mortgage, also how much time you have remaining on your loan term. So for example, like, this is a example for a 50 years old, homeowner. Let's say he has 150,000 remaining on the mortgage, and he has about 12 years left to pay off, the loan. So a MPI policy that covers the remaining loan balance you need is 150,000. So you usually, the expected mortgage protection is maybe about $28, $29 per month. It's not that much, but there is a limit. I think the requirement is once you close your loans, some companies will allow you up to 24 months after you close your loan to buy the mortgage protection insurance, right? Yeah, or within the 5 years. So there is it's kind of like a timeline requirements for that. So that's the difference between a traditional life insurance policy versus the mortgage life insurance that protects your house only. But the upside is that a lot of mortgage and mortgage life insurance that protects your home does not. You don't have to go through an underwriting as far as health requirements. So that's a good thing for those that having working in a job that high risk that you may not qualify for a traditional life insurance policy. So this could be an options for you to get for protection. And also, beneficiary. Do you think who would be the beneficiary for the mortgage life insurance policy?
Yeah, so definitely the heirs, who are going to receive the asset. And hopefully you have your living trust and your will and your other estate planning mechanisms in place so that there is a smooth transfer of those assets by just basically making simple filings. I was actually talking to a friend of mine whose mother recently passed, and he was saying how proud he was of his mom for having all of her things in order.
Mm-hmm. Yeah.
She had all of her affairs in order. And so that has certainly made handling of the estate easier, and instead of dealing with disputes, the siblings are able to work together to deal with the legal transfers, and more importantly, then also deal with their respective grieving process.
Yeah, it's good to have trust in place, and in event of something happen to you or your spouse, so your family don't have to worry about going through that whole process of probate. As far as the mortgage insurance policy, a lot of people would think that the beneficiary will go to your family, but it's not. It's go to the lender because it protects. It goes to the lender if something happened to you, so that amount would pay directly to the lender. So it's not paying directly to the family, to your family as a beneficiary. The beneficiary here is the lender.
Oh, yeah. You have a balance of the mortgage.
You have the balance.
Yeah. You have a balance. Absolutely. That is correct. Right. Yeah.
So the balance, the balance, the mortgage policy can go down, as time progress, that value of the policy can go down, because as you pay more into your loan, then the balance remaining will be shrinking each year, right? So the amount of that you pay in each year, or the value of the policy will decreasing each year, depending on how much you pay in. Yeah.
And that's important because a lot of times those are things that you're concerned with when you're managing cash flow, right? And what are the various expenses? What expenses can you adjust? How can you get relief? And that is realizing that as the balance outstanding is reduced, then the amount of coverage that's required becomes a lower amount. So you're sort of reducing as you're paying down the balance.
Yeah, because the nice thing about the mortgage protection insurance is that you don't have to go through a medical exam to qualify. Most people qualify, just paying, just you can just get it from a mortgage lenders or certain insurance companies will offer these protections. So it's easy. It's easy to get, but there are some rules and regulation applying to the mortgage policy, and that is the debt benefits. Usually, it's just a remaining balance of your loan that goes to the lender. So it does not go to your family. So this is something that you would have to consider if you're able to qualify for a traditional life policy. I would just get that because you know why? Because the beneficiary is your family. So if something happened to you, that amount will go to your family, and they can just receive a lump sum from the insurance company, and you can pay however you want or spend however you want. Versus the mortgage protection is only for the remaining balance of the policy, regardless of how many years you paid in. So that's
Absolutely.
yeah.
Okay, so yes, I can recognize how you're distinguishing between the two
Right.
types of policies is that you're talking about using a traditional policy with a rider potentially, or having a lump sum as the benefit amount that then the heirs can decide how to allocate. So one of the things that they could do is to pay
Right.
off that mortgage balance and other
And
things,
not to worry about it,
as well
right?
as, yes,
Yeah.
exactly. Whereas if you just have a policy that's specifically for the mortgage balance, then
Then
that's
it's just
all
for the
that's going
balance of
to
the
be
mortgage.
addressed.
Yeah.
Yeah.
So it's
Yeah.
specifically for that because the rules and regulation apply for that particular policy. But if you were going to have a traditional policy, which I highly recommend, if you can do that because you have more flexibilities, and also the beneficiary is your family, not the mortgage company. And
Sure.
when you receive a lump sum, if you were going to pass away, that lump sum goes to your family and they decide where to pay. They can pay mortgage, they can pay for loans, they can pay for college, medical bills, or however you like to spend that amount of money, which is awesome, right? To have that flexibilities to take care of your family.
Absolutely.
The like I mentioned earlier, is the mortgage protection insurance. Usually, most companies require your insurance policy within the 24 months of closing your loans, the loans of your house, and sometimes they allow up to 5 years. So make sure if you just close your loan, this is an option that you can explore to get protection for your mortgage. Otherwise, if you've been paying it for the last 5 years, 10 years, look into a traditional life policy that can provide you more flexibilities if you're able to qualify for it, because you have to go through sometimes medical underwriting if your health is not in good condition for it. Yeah.
Yeah. And the other thing that's important, I think, really in this conversation is reminding people to check into what type of policies, what type of estate planning you have in place. Because again, as policies change, I was explaining to someone about how capital works and portfolios. At different times, different companies provide different policies that have different options. And of course, they're based on a number of things. They're looking at the data of, what has happened in terms of the life cycle of a policy, as well as what seems to be the common demands and needs of a marketplace. And then new policy options are made available. And so sometimes if it is that you have put in place policies, or you have employer put in place policies, those policies at that time were good for that particular time based upon the options.
Exactly.
Haven't checked the marketplace, there might be new options that are available. There may be new additional benefits. There may be different riders that you can add to a policy, and things like chronic conditions, critical care type conditions, suddenly losing your ability to be gainfully employed because of a sudden disability, and things of that nature that can alter the state of your planning, the economy of your family. It's great to know that sometimes your policies are another source of safety, a safety net that you may not have thought about. And those are the living benefits. You know, people think
Right.
of life
Those are
policy
important. Yeah.
perspective of the death benefit, but what about the living benefits?
Yeah. Mm-hmm. And most people say, "Oh, I have insurance through my work." Well, that is great because your work provide you additional benefit to for them, as a way to attract you. But most of them, the life insurance offered by your work is usually just term policy, and as soon as you leave your work or no longer with them, that term policy is going away. So you're not protected. So you want to get one that on your own so that you can protect it for a lifelong, for your whole life. Um, so you don't have to worry about it later on, because as you're getting older, it will be harder to get a policy because based on medical underwriting, you may not qualify for it later in life when you have more medical conditions, or you're getting sick, and it could be more costly by then. So then, it's good to consider a traditional life policy as part of your mortgage protection, because it has all these benefits that you mentioned earlier, living benefits, accelerated, they say ADR, accelerated death benefit riders, that you able to access that money, the death benefit earlier if there's a medical conditions, critical illness, heart attack, stroke, Alzheimer's, things like that can happen. And if you're no longer able to work, where do you access your money to pay your mortgage, to pay your bills, to carry on with your life? So it's important that you have that benefit available in event something happen. And also, debt benefit go to your family tax-free. We're talking about tax-free debt benefit and lifetime income, as it's like your personal pension account, right? So it's good to consider that as part of your planning if you are a policy owner. So let's talk about MPI, or mortgage protection, pros and cons. What are the pros that you think to have a mortgage protection insurance?
Well, again, it's things like these sudden instances where you may find yourself unable to pay for your mortgage. And because it's such a long period of time that typically you're committed to the mortgage, when we think about it, if it's even a 15-year mortgage, a lot can happen in 15 years.
Exactly. Yeah.
15, if it's a 30-year, a lot can happen in 30 years.
Right.
And so when you think about the time that you take on that mortgage versus that 30-year window, if you purchase a home in your 40s, 30 years, if you just make the regular payments, and if you don't refinance or take out any of the equity, then you're going to pay on that until you're in your 70, typically. And so what can happen between 40, 50, 60, and 70 are a lot of different things along your journey.
Yeah, the one of the pros, or the pros to have MPI is the guarantee policy acceptance, meaning you don't have to go through a medical underwriting, like I mentioned earlier, to qualify for the plan. So that's the nice thing about it. And, peace of mind for your family, right? That is important, to have something in place if something were happen to you. Now, the cons of having an MPI, mortgage protection insurance, is what you have to pay extra out of pocket.
Sure. Those
Right.
next costs
Yeah.
factor. Absolutely.
And limited payout option too. Like I mentioned earlier, it will pay out to your lender, not to you or your heirs. So, that is something that you need to decide, is the mortgage protection insurance right for you or the traditional life insurance right for you. So consider other alternatives for other policies that could provide you more potential access and benefits, protections. Yeah.
Absolutely. And I think that this is important, when you talk about just your overall planning, when you're planning, what are my requirements and commitments just to kind of take care of my daily living, as well as, my future, my long term, what are going to be some of the needs. And so I think it's important to keep a mindset about, what is it that I would like my next 20, 30 years experience to be for not only myself and my family, and what happens if there's certain shifts. One of the things that you mentioned that's always important is when you receive lump sums of resources, a cash payment, for example, if it is that you receive those proceeds tax-free, that's a significant benefit,
It
because
is.
think
Yeah.
about receiving large sums of money. Oftentimes, those funds are taxed. So, although it appears that you're getting X, by the time, depending upon your tax bracket, the taxes are deducted, it's a much smaller sum. And so, when you can receive a sum that is the full amount without implications in terms of a tax liability, that turns out to be a huge benefit.
And like you're absolutely right about the tax issue, because we don't know what our tax bracket going to be in the future, or how much tax in the next 10, 20, 30 years, right? With that in mind, you want to make sure that if you receive a lump sum from any source, make sure it's a tax-free lump sum, because
Mm.
that could be huge. We're talking about 30-40% tax.
Yes.
And you could use that for whatever the reason that you want, to have more,
Yeah.
right?
Yeah.
And
I would
yeah.
say if you get an opportunity to not have to pay the taxes, then I would definitely look at a way that can have that money work for me in another, positive way, so allocate part of that money towards some other compounding opportunities that will also continue to provide a tax-free
Yeah.
disbursement
And,
in the future.
the traditional life policy can offer you so much more than the mortgage protection. It depend on your situation, where you are, your health condition, and what your goals are. So you can choose between the two protections. But traditional life policy can offer a lot more living benefits, and also the yeah, the lifetime income that provide you that flexibilities if you were going to live longer, right? And something happened to you, that money can go to your family. Now, with the the mortgage protections, if you are, like, let's say, if you are the main wage earner for your family, you, like the husband or the wife, if you are the main breadwinner for your family, if something happened to you, you walk out that door and you don't come back, have a plan in place to protect your home, to protect your loved ones? So those are the things that usually we don't think of, right? Because in Asian beliefs, that sometimes we're like, if you're thinking about bad thing would happen. So
Sure.
they would just put it back in the back burner and not to think about it,
Right.
because it's bad luck to think about it. It's like, do not think about it. But this is not something that we can avoid. if something that you can plan in advance to protect your family. Imagine if you are a family with, 2, 3 kids. If something happened to you, is your kid protected? Is there a safety net that catch them? Is there a house that paid off so they don't have to worry about it? Would they have money to pay, for their college? So those are the things that you want to consider when having a protection for your home, and also traditional life policy that provide you so much more. But again, it depends on your goals and what you want to protect.
And that's really what I think it is. It's about beginning with the end in mind and thinking about what is it that you'd like to protect? What is the legacy that you'd like to leave and transfer to your beneficiaries? Well, as usual, Andrea, the time has come and gone, right? It's amazing how quickly our weekly conversations happen, right? I hope that this information was beneficial to someone out there considering how to plan out not only their family's economy, but also really their estate planning. What are the succession plans? What are the estate planning tools that you need to consider so that you can put in place a beneficial transfer of assets for your heirs and beneficiaries?
Well, thank you so much for joining us today, and we really appreciate your, presence, and hope you found this session, helpful. So we're here live every Wednesday at 10 a.m. Pacific time. So please join us next time. And if you have any questions, please email us at info@welldoctors.us. Until then, we hope that you have the most wonderful day and a wonderful week ahead. And if you have a plan in place and need to review or update your plan, which you should do annually, please reach out to us. We can help, whatever we can do to help you to review it, or suggestions, or add on more values to yourself. So please send us a comment, or send us a text. We would appreciate it. Thank you.
All right. Take care.